Welcome back to the deep dive. We're here to cut through, well, just a massive amount of news hitting us lately. You've got Fed decisions, big tech earnings pouring in, some companies hitting major roadblocks. Our job, really, is to pull out the key strategic shifts, the numbers you actually need to know from all that noise. There was a lot this week.
Oh, absolutely. A monumental stack of information. And what makes it trickier is that the big macro picture is kind of fuzzy right now, thanks to that data blackout from the shutdown. So yeah, our mission today, find the signal in the static, figure out where the big money is really moving, what bets are being placed.
Okay, perfect. Let's start right at the source where all capital flow kind of begins. The Federal Reserve, we got that second consecutive rate cut, right? 25 basis points?
Yep, 25 basis points
Yeah.
brings the target range down to 3.75% to 4.00%. That part was, well, mostly expected, but maybe just as important, they also announced they're ending quantitative tightening, QT.
Right, the balance sheet runoff.
Exactly. They're stopping that reduction of their bond holdings on December 1st. That's a pretty clear signal.
Yeah.
They're basically done pulling liquidity out of the system. The focus seems to be shifting towards stability, maybe even a bit of easing.
And the vote itself that split tells a story, doesn't it?
It really does. You had Governor Miron wanting a bigger cut, half a point. He's clearly worried about growth slowing down too much. And then on the other side, you had President Schmid from the Kansas City Fed saying no cut at all. He's still worried about inflation.
So a real disagreement there.
Oh, yeah. That kind of spread suggests, future meetings could be pretty contentious. They've got fundamentally different reads on the economy right now. Is inflation truly beaten? Are rates too high for the labor market? Big questions.
And Chairman Powell, he definitely tried to pour some cold water on the easing excitement, didn't he?
He did. That line about a December cut being not a foregone conclusion, far from it, that was strong language. And you saw the market react right. Stocks gave back some gains. He wanted to make it clear this isn't some predetermined path.
But the Fed's making these calls with, well, less information than usual.
Exactly. That's the big constraint. The government shutdown, now in its fourth week, it's really choking off the data flow. We're missing key stuff, like the jobs report, retail sales data, CPI, the inflation number is one of the few things we did get recently, but overall they're kind of flying blind.
And that has real costs. The CBO, the Congressional Budget Office, they put numbers on it.
They did. They estimate this 4-week shutdown, it'll shave at least $7 billion off GDP by the end of 2026. If it drags on for 8 weeks, that could double to $14 billion. That's a real economic hit.
So if we tie this back to strategy, to where capital flows, this easing, even if cautious, what does it mean?
Well, it brings up that tricky issue of inequality again. We know lower rates tend to boost asset prices. And what happens then? Liquidity chases those high growth, maybe high risk assets. Think big tech. Look at the numbers since early 2020. Financial assets for the top 0.1%.
Yeah.
Up over 91% for the bottom half. Up about 46, 47%.
Wow.
So this concentration we see, especially in tech, it's almost a feature of this monetary environment, not really a bug, if you think about it.
Okay, so that sets the stage. If the Fed's policy is likely to keep fueling asset prices, we need to know which assets. And that takes us straight into big tech and this AI arms race.
It's absolutely the defining theme. The spending here is just massive. You're seeing companies practically cannibalize parts of their own businesses just to free up cash for AI compute power for development.
Okay, let's start with Alphabet, Google's parent. Their quarter wasn't just good, it was phenomenal.
Really.
Yeah.
Stock jumped 38% in Q3. That's their best quarter in like 2 decades. And that pushed them into the $3 trillion market cap club, alongside NVIDIA, Microsoft, Apple. Very exclusive company.
And they got some good news on the regulatory front, too,
A
right?
huge win, actually. In that big DOJ antitrust case, Judge Mehta ruled against forcing them to sell off the Chrome browser. And crucially, the judge actually called the generative AI market highly competitive. That's massive for them strategically. It helps protect their core ad business.
And they're pushing out AI products like crazy.
Oh, yeah. The Gemini app even briefly knocked ChatGPT off the top spot in the Apple App Store. They launched Gemini Enterprise for businesses, put Gemini right into the Chrome browser for desktop users. It's an aggressive rollout.
But to fuel this, they're cutting back elsewhere.
Seems so. Reports indicate they cut over a third of managers who are overseeing smaller teams. That's a clear strategic choice. Streamline, focus everything on AI, prioritize that speed.
But does cutting managers like that create risks? Maybe missing the next big thing because you trimmed that layer of oversight or creativity?
That's the million-dollar question, isn't it? It's the management paradox of this AI era. They're betting that the focused efficiency on AI is worth more than maybe the decentralized innovation those managers might have fostered, sacrificing breadth for AI depth.
Okay, then you have Microsoft. They seem to be locking in future revenue through OpenAI.
Exactly. Analysts were looking for big numbers from them, like $75 billion in Q1 revenue. And a huge chunk of that expectation, like 37% growth, was pinned on their Azure cloud business.
And the OpenAI deal really solidifies that Azure growth, right?
It absolutely does. Microsoft gets that 27% stake in OpenAI's for-profit arm. But the really critical part, OpenAI agreed to buy an incremental $250 billion in Azure services over time, $250 billion.
Wow.
Yeah, that essentially locks in a massive stream of recurring cloud revenue. It really de-risks their huge infrastructure investments.
So a bit awkwardly, didn't that news come out right after an Azure outage?
Hey, yeah, the timing wasn't ideal. A little dose of reality there. Just hours after some Azure and Microsoft 365 services went down. Reminds you that even with all that capital, nothing's perfectly infallible.
All right, let's shift to Meta. Big revenue expectations there too, but maybe more internal tension.
It definitely seems like it. They had layoffs, right? About 600 people in their Superintelligence Labs AI unit. But at the same time, they announced this massive joint venture, a $27 billion deal to build a giant data center in Louisiana.
So spending big on infrastructure, but maybe cutting back on some of the more research-y AI teams.
That's how it looks. The capital is flowing, but maybe more towards core compute power rather than every single high-cost research project. And you still have Reality Labs, the metaverse bet, which is just, well, burning cash. Expected to lose over $5 billion operating loss this quarter.
Yikes.
Yeah. And while their Meta AI app saw downloads jump like 56% month over month, which is good, it's worth noting OpenAI's Sora app, their video generation model, actually got more iOS downloads in that same time frame. So leadership is still very much up for grabs.
And underpinning all of this spending, you have the hardware guys, the infrastructure builders.
Absolutely. They're the silent, or maybe not so silent, winners here.
Yeah.
The money has to go into the foundational stuff. I love that quote from the Celestica CEO. He said, if AI is a speeding freight train, we're laying the tracks ahead of the freight train.
Perfect analogy.
Right. They design and build the networking, the storage systems. They partner with chip makers like Broadcom on the latest fastest silicon, like the Tomahawk 6 chip, all designed to feed the insatiable demand from Google, Microsoft, Meta. And briefly, NVIDIA even touched a $5 trillion valuation. Plus, they announced a $1 billion stake in Nokia for 6G tech. The infrastructure build-out is just immense.
Okay, so that brings us to a really interesting contrast, because not all the big corporate news is about this AI hypergrowth. Some giants are dealing with, well, some pretty serious operational headaches. Old economy meeting new challenges.
Yeah, this is where things get messy. Look at Boeing, a really mixed bag for them. On the one hand, they actually generated positive free cash flow, $238 million. First time they've been in the black since late 2023. Plus, the FAA lifted the production cap on the 737 MAX up to 42 a month. Those are definitely positives.
But then there was the other shoe dropping, a big one.
A huge one, a $4.9 billion charge related to more delays on the 777X wide-body jet. They're now saying the first delivery won't be until 2027. That's a massive setback.
What does a charge that big, almost $5 billion, actually signify strategically?
It's way more than just an accounting number. It reflects huge costs for inventory write-downs, for rework. It means revenue they expected is pushed out for years. And strategically, it signals ongoing major instability in their production. It hurts their ability to compete for those really lucrative long-haul plane orders. It basically hands a big advantage to Airbus. Huge hit financially and reputationally.
Then you see ripples in the EV sector, General Motors.
Right. GM laid off over 1,700 workers. Yeah, that hit sites in Detroit, but also their Ultium battery plants in Ohio and Tennessee. And they were pretty direct about the reason. Slower, near-term EV adoption.
So the reality is hitting the hype.
Pretty much. This is GM bumping up against manufacturing reality. The initial excitement assumed this smooth, super fast adoption curve. But the regulatory landscape keeps shifting. The cost of building these massive battery plants is enormous. Retooling assembly lines, it's all incredibly expensive. So pausing battery cell production starting in early 2026. That's a huge, costly signal. They're having to recalibrate their entire EV plan based on actual demand, not just the rosy projections.
We also saw a big shock in fintech with Fiserv.
Yeah.
Stock tanked.
Oh yeah, plunged over 40%. They slashed their full-year guidance and missed their Q3 earnings numbers. And the CEO pointed the finger very specifically. Argentina's deteriorating economy.
One country had that much impact.
Apparently so. Get this. Argentina alone had previously contributed 10 percentage points to Pfizer's organic growth rate. So when that single key market goes south fast, it can completely wreck your global forecast. A classic example of geopolitical economic risk hitting a specific company hard.
And lastly, on the restructuring front, media consolidation. Paramount Skydance making cuts.
Yep. About 1,000 jobs going immediately, with plans for maybe up to 2,000 total cuts. It's the standard playbook after a merger, unfortunately. Slating redundancies, trying to find those synergies.
Tough news for those employees.
Absolutely. But from the company's view, these are seen as, well, necessary steps to get the scale they need to compete. The CEO framed it as combining forces to stand a better chance against the streaming giants, the ones with seemingly bottomless pits of money.
Okay, let's pivot now to the consumer. Because things are changing fast there too, driven by some really fundamental shifts. Health and wellness, for instance. Specifically GLP-1s.
Yeah, the weight loss drugs. This is a seismic shift. And it's already showing up in how people spend money, what retailers are doing. Eli Lilly just teamed up with Walmart. Big deal. To expand access to Zepbound, their GLP-1 drug.
And this is Lilly going direct to consumer, but using Walmart's footprint?
Exactly. It's Lilly Direct's first retail partnership. So now, patients paying cash can get these discounted single-dose vials like $350 to $500 a month just by picking them up at one of Walmart's almost 4,600 pharmacies. It dramatically lowers the barrier for people without insurance coverage or high deductibles.
And that direct strategy seems to be working.
Hugely effective. It already accounts for over a third of all new Zepbound prescriptions. Lilly is clearly betting that making it easier for capped peers is a massive growth driver, helping them compete fiercely with Novo Nordisk.
And you're saying this health trend is directly impacting other consumer categories, like snacks?
Oh, for sure. Look at Fruitist. They're known for those jumbo blueberries. They just raised $150 million. JP Morgan led the round. Ray Dalio doubled down on his investment. That's serious money for blueberries.
Why the big bet on healthy snacks now?
It ties right back to the GLP-1s. The Fruitist CEO specifically mentioned their research shows people on these drugs are eating virtually less of everything except for fruits and vegetables. So the thinking is healthy snacking isn't just a nice-to-have anymore. It's becoming a central high-growth category, partly fueled by these drug trends. That justifies that big investment.
Okay, so from blueberries to strip malls, what's happening with retail real estate? We hear so much doom and gloom about commercial property. Where's the bright spot?
Well, it's niche. What's interesting is looking at Nuveen's strategy, they're really focusing on a specific type. Grocery-anchored, open-air strip centers. And the numbers kind of back it up. Vacancy rates in that sector are super low, nearest historic lows, actually, around 4.4%. Their own portfolio occupancy is strong, over 95%.
So why are these places doing okay when, say, office towers or enclosed malls are struggling?
Couple of reasons. First, they call it essential real estate. These places have grocery stores, pharmacies, maybe some quick service restaurants, things people need regularly, stuff less disrupted by e-commerce. Second, they're more liquid. They're considered bite-sized deals. It's much easier to finance and sell a $20 million strip center than a $500 million office tower, especially in a volatile market. So even if overall rent growth is slowing down, these specific assets are seen as relatively stable, lower-risk bets.
Okay, so let's try to wrap this all up. We've got the Fed cutting rates, but cautiously, and dealing with data gaps from this shutdown. Capital stays relatively cheap. You have big tech locked in this incredibly expensive AI infrastructure war. Then you have these legacy companies like Boeing, GM facing billion-dollar setbacks, major restructurings, a real split screen.
It really is a dual market right now. You've got one part driven by almost exponential AI growth, locked-in cloud contracts, immense capital spending. And the other part is grappling with high borrowing costs, shifts in consumer behavior like the bumpy EV transition, and just the brutal reality of manufacturing delays or market shifts like we saw with Pfizer. Efficiency and really sharp data-driven decisions are absolutely critical everywhere.
All right, let's end with one final thought, connecting that huge AI theme back to something very consumer-facing. Style and culture. Target's making a big push.
Yeah, Target's trying to recapture that Target magic, right? Their style reputation. And you hear about their new CEO, Michael Fidel, sending design teams on these inspiration trips, rodeos, fancy ski lodges in the French Alps. Sounds very human, very high touch.
Right. It seems like old school creative work, but there's a twist.
There is. Because alongside that human element, they're leaning heavily on AI. They've built this tool called Trend Brain. Apparently, it analyzes just vast amounts of images and data to forecast trends, colors, material styles much closer to when the products actually need to be deployed.
So it's this fusion, human intuition from the trips plus algorithmic prediction from TrendBrain.
Exactly. And it makes you wonder, if a huge retailer like Target is now using AI to help dictate what's fashionable, what's next in design, it poses a provocative question for all of us, I think. In this incredibly fast-moving consumer world we live in, what's ultimately going to drive demand more? Will it be human creativity and inspiration, or will it be the predictive power of artificial intelligence?
A fascinating question to think about. Thanks for walking us through this packed quarter. Lots to digest.
Always interesting. Thanks for having me.